and welcome to the Dash Trader Newsroom. More market mayhem or buy the dip? My name is Michael DeGioia, and I'm joined by my co-host Jill Malandrino, Global Markets Reporter at Nasdaq. Jill, how are you?
I am doing very well. It is great to see you in 2022, and certainly no shortage of things to talk about.
Yes, absolutely. 2022 has started off with quite a fervor here this year. I mean, we have all the things that we've been talking about all through 2021 starting to come to fruition. The first item that we pretty much spoke through the entire year of 2021 was inflation. Is it transitory? Transitory became not so transitory. So we have these inflationary concerns that have really been pushed to the limit. Looked like we had almost 8% annual inflation last year. Which brings us to the next item, which is the central bank, the Federal Reserve Bank, which just released its notes yesterday, basically saying that they're going to be raising interest rates in 2022. And what that has led to is one of the fastest declines in the market from the start of the year in anybody's recollection, maybe since 2008 was the last time we had this kind of precipitous decline. So the big question is the super bubble over, Jill? What are your thoughts?
Oh, wow. There's so much to unpack there. And it's something that we've been covering frequently on my show. And I think everyone's in agreement that we were in such a high valuation environment that the reset needed to happen. I think what's really taking traders and investors by surprise are the velocity of the moves and what we're seeing in the volatility markets. I mean, Mike, we're round tripping 2, 3, 4% a day, which makes it challenging for traders. Longer term investors, you're acquiring shares for your 401k, for your IRA. If you're looking for longer term entries, there's a positivity there. But for intraday traders, day traders such as yourself, it really has been quite a few weeks of trading for you. But I think really, when we talk about interest rates, now there's some people that are pricing in 5 interest rate hikes for the year. I don't know. I think I'm of the camp, perhaps 2 to 3 might make more sense. I think really what the Fed is focusing on is the inflation number. And while we know it is at excessively high levels, I think once we get onto the other side of Omicron, assuming we don't get another variant or whatever, that you're going to start to see the shift in spending from goods to services and experiences, a pretty dramatic shift. Because we've been spending money on our homes, we've been spending money on all the goods, but we haven't been spending money on vacations and concerts and everything that falls under the experience category. So I think in addition to what the Fed is doing with interest rates, just the natural shift in demand should, in theory, help that as well. I don't think it's any surprise that we get one in March. I don't think it's any surprise that we get one, shortly thereafter. But I think the 3, 4, 5 is really what the wild card is. And I think, again, that inflation number is really what's going to be key. And I think the consumer is going to also help the Fed along with that, as we should see that shift in spend. But, in terms of bringing the market down to more attractive valuations, it needed to happen. We had companies, we had a lot of companies come to market last year, many of them unprofitable, many of them with no revenues, certainly not revenues to match their valuation. And, you're kind of seeing those outliers being shaken out here.
Absolutely. I mean, we have a big one coming out today. We have Apple's earnings coming out. I'm sure everybody's interested to see that. Microsoft had pretty good earnings. They came out yesterday or the day before, rather. So we've had some interesting earnings that we're going to talk about a little bit later on. From my perspective, I'm a little concerned, though, because obviously in 2020, we had all the stimulus money. I think that consumers have gone through that stimulus money. In 2020, they saved a lot. Consumers saved a lot because nobody was going out in the beginning. I think they've gone through their savings. I think that last Christmas, they said that credit card spending is now the highest that it's been, in a number of years. So I think they've gone through the stimulus, the savings, and the credit card spending. And I think that, I don't know how many bullets the consumer has left. If the economy starts to slow down and the market starts to slow down, the first thing that companies are going to do are cut jobs one thing I've already noticed in looking at the earnings that have already been announced is that, I mean, labor cost is cutting into all the bottom lines. All the banks, which generally do well in a rising interest rate environment, all the banks are really taking it on the chin because of increased expenses mainly due to increased labor cost. So what are your thoughts about, the cost of labor? I mean, it's the biggest factor in most corporate businesses.
Right, it certainly is. Your fixed expenses such as office space, travel, salaries and so forth. And it's not even just salaries and bonuses. It's also benefits that cost companies a lot of money. And as we're very well aware of, you have companies across every industry and vertical competing for, let's say, tech talent as an example. And those are jobs that command high salaries. They command very good benefits. They command that flexible work schedule. That's just what the younger generation and the new tech talent is demanding, for better or for worse. But there's been a dramatic shift in workplace culture, and companies are going to need to learn how to figure out how these fixed costs are going to play into their earnings and so forth, because it's not going to go away. This is something that is not transitory. You can't hire employees under the guise of making a certain salary to attain them and then not have the same retention policies. So it's not something that's transitory when it comes to salaries. And I think companies are going to have to make hard decisions in terms of where they compensate in other areas to make up for these fixed costs. And we saw it across the board. It's just not the financial institutions, it's everywhere. And my concern is there was such a dramatic hiring spree that occurred because of the way jobs are shifting. Everyone is looking for more data analytics. We are looking for AI and machine learning to do certain things. Everyone is hiring content creators. So, my concern is that companies are going to have to make these decisions where, do we have to make cuts to keep our core business revenue sources coming in to balance out what our earnings look like? That's always a concern. Fortunately, the job market's out of balance a bit, so I don't think that's something that's going to happen in the near term. But the pendulum always shifts, Mike, as you know, one way or the other. So perhaps there was a lot of power in management, and it shifted towards worker demands. And I think there's going to have to be some sort of a happy medium if they want to keep shareholders happy. But in the same token, governance and employee culture is such a big thing right now that you have to have a strong track record there if you want to retain the right talent. So it's a balancing act that corporate teams are going to have to figure out how to manage.
Absolutely, without a doubt. I mean, so far the trends that we've seen this year from an earnings season perspective is that banks have done fairly poorly in terms of their trading divisions. So in the past, trading revenue had been very, very big, a big benefit to the earnings of the various different banks. We see costs going up. In the technology companies, a lot of tech companies are very, very big borrowers with the expected cost of money going up. We've really seen a turn down in the Russell 2000 index. The Russell is really in the downtrend, almost approaching bear market territory. And just to review, 10% is a correction, 20% or greater is bear market, 30% is, basically what we pulled back on the post-pandemic, the start of the pandemic. We went to like 35, 36%. The earnings so far have been good, but the fact is that you've had two kind of extraordinary years. All the tech companies, the growth for like a company like Netflix got hammered, destroyed, because the market has kind of, is kind of turned more bearish. Plus, Netflix has had such phenomenal growth over the last 2 years. Nobody expects that to continue. So I guess it's kind of an interesting thing to watch. Certainly, I think that the valuations had kind of gotten astronomical, and that we just needed to come back to earth. The other thing too is, all these buybacks, share buybacks, have really driven up price to earnings ratios because you have less have less shares outstanding. So your EPS, earnings per share, if you buy back the shares, then you have less shares, so the earnings is greater per share. So it's kind of like they've been playing a little bit with kind of these schemes, and I think that we're starting to see the after effect of all of this starting to unwind.
Yeah, it's interesting. I had a guest on my show and we were talking about that, and he brought up the same point that you had made. And we know that financial engineering and earnings, a lot of that happens because of share buybacks. We've seen a number of companies who basically made a practice out of that. And I thought it was really interesting how we did not hear much about share buybacks in this particular quarter. And we know that it's not going to get any cheaper to borrow. It's only going to get more expensive. So, how will that impact share price if there are less buybacks that are being taken place? But, Mike, I will say in the same token, we're at 0% rates. This is historically low. I mean, Europe is just coming back from negative rates. If the market and the economy can't digest 25 or 50 bips in an interest rate rise, we have bigger issues than just an interest rate hike.
So you're right.
Yeah.
I think you're right. If we can't adjust to a quarter, a half, or 0.75%, I think the economy's got bigger problems.
Right.
All right. So on that note, that brings us to the souffle, the conversation of the day. What's going on? I mean, this is like, I always joke around. I said, this is like the playbook. The economy starts to falter, and then all of a sudden the conflict arises. This one has been certainly brewing for a while. What are the root causes between the Russia-Ukraine conflict? I mean, from my perspective, there's this big geopolitical problem, right? You have Russia saying that NATO is infringing on its borders by kind of wooing and romancing the Ukraine, and the Ukraine kind of is swaying in the direction of the West closer and closer. Yet at the same time, there's also this big issue of natural gas and the natural gas pipeline, which might be the real story here, right? Because it seems like the United States is subsidizing cheap natural gas prices by selling directly to Germany, whereas Russia would like to sell natural gas to Germany via the pipeline that runs through Belarus. The question is it really the whole NATO expansion thing, or is this an issue of natural gas? There's been some crazy volatility in natural gas prices, and certainly, what do you think about the likelihood of a conflict between Russia and the Ukraine? What stocks and what effect could it have on the markets? I mean, what do you think about it overall?
Yeah, it's I took a look at a couple of research reports, and interestingly enough, stocks typically don't have a longer term negative reaction to events such as that. I believe it was LPL Financial put that research out, and it was interesting. Short term there might be something, but longer term the impact isn't quite as dramatic as a political situation may be. And again, this is outside of the realm of personally how it impacts people. I don't want to be insensitive to that, but Mike, I also feel like Putin and the Russian regime, they tend to test every new administration that comes in.
Yeah.
North Korea is infamous for that. China to a certain extent. It's no surprise that Putin wants to unify the Soviet Union once again. We know NATO is always going to be an ongoing issue. I don't think any of these issues are necessarily new. I think a lot of it is just a test on the administration, which kind of is how he operates. And anytime it impacts natural resources, it's going to escalate. Obviously everyone's goal, at least in Western Europe and the US, is to resolve this diplomatically and through sanctions. But we'll see. I quite honestly, I think the Biden administration's been a little bit more aggressive than I had expected. But I think from a market point of view, it might not be as impactful as interest rates or something that spooks the market all the time.
Yeah. So what do you think about the whole natural gas issue? Do you think that that's the real underlying item?
Yeah, I mean, with the exception of the power grab, that's always going to be around. I mean, of course, anytime there's um, it's around a commodity or a natural resource. I mean, Mike, it comes down to money at the end of the day, and who has it
Yeah.
and who doesn't, and the competition for it. I mean, look at what's been happening in the Middle East for I don't know how many years.
Yeah.
What does it all boil down to at the end of the day? I mean, why else would we have any other business there?
Yeah.
So.
And speaking of the Middle East, from my recent trip there, what I did not realize is I believe that they are repositioning themselves because they know their oil reserves are running out. I mean, it seemed like that was the one thing that I did not know before going to Dubai and the United Arab Emirates, is that they are kind of well aware that they need to diversify their offering, because they've been completely reliant on their oil reserves for everything. And that was really the motivation and the creation of the Las Vegas of the desert, in the Middle East, which is kind of Dubai. It's the Las Vegas without casinos, which,
Right,
by the way, they may eventually bring casinos, which would be shocking in a Muslim,
right. Yes, especially if they practice Sharia law. But
Yeah.
I think, Mike, even from observations, and one of the reasons why they had that massive IPO, it's another way to capital raise. You're also starting to hear more about ESG in that particular region, because that it is from investor perspective, for right or for wrong. Governance is certainly at the top of the list, and the fact of the matter is, many companies won't do business in the Middle East for governance reasons. So that's that. I also think that you will see them try to become a center when it comes to digital assets and cryptocurrency. I mean, Mike, you're in Miami all the time. You know what's happening in Miami. They are doing a big push to attract that newer, younger talent. And I mean, that's kind of been the trend out of Silicon Valley into New York, into Miami. And I think you're going to see that globally as well, particularly because you don't need the offices and infrastructure to do so. So I think ESG and digital assets is kind of going to be their next economy.
Yeah, there's actually a cryptocurrency digital asset conference going on right now in Miami. I think it's Battlefin. And when I was in Dubai, there were two different crypto events while I was there, besides for the World Expo that they were doing. Yep. So certainly you do see them. They're trying to woo the talent and try to play on that market. In terms of stocks, I mean, I the ones that pop to mind and, that would do well are the companies that really haven't done well for a long time, which are kind of the defense contractors, right? I mean, you got the Raytheons, the Lockheed Martin, the Boeing, right? I mean, they would probably benefit if there was a conflict of some kind anywhere in the world. And, the big three is, you got the old standby in the Middle East, right? There's always some kind of trouble brewing in the Middle East. You got the Ukraine-Russia potential conflict, and then the other one is Taiwan and China. And I think part of Biden's response of trying to be tough is because he also wants to show maybe China that he's going to be tough if there's a conflict or some kind of threat occurs. So I think there's a little posturing there. So
yeah.
All right. Well, thank you so much, Jill. It was great to have you back. And I'm going to jump to the charts. And it was a great first newsroom for 2022.
It definitely was. Great to see you, Michael. Talk to you soon. Take care.
All the best. Thank you so much.
Yeah.
All right. I'm just going to switch to the charts here. We had a pretty crazy session as always here today. And you're going to see when I pop up my screen. So what I'm doing today, this is the CCI. You can see that we're starting to get a divergence on the QQQ. This is the 1-day chart of the QQQ with the CCI. And I really wanted to point this out. This is an interesting divergence on the CCI. We have gotten deeply oversold, and then we have gotten a little bit less oversold, but we've come back above the 100 line, the negative 100 line on the CCI. I'm going to pop up and I'm going to load up my charts because I want to put on the MACD as well. Let's see if I can find the MACD and the CCI. MACD, MACD. Let me bring it here. Here you go. So this is the MACD with the CCI. So here we have it. I'm just going to make this a little bit bigger so we can all see it better. You can see my DAS flying with all of this data. You can see that we have the MACD is a lagging indicator, whereas the CCI is a little bit of a leading indicator. And what you can see here is that the CCI is indicating that we might be ready to pop, which would, if the CCI continues in this direction, we might be in for a relief rally. But when I put on the weekly chart, okay, you can see that this big uptrend has finally been broken. Okay, this is the pullback and to the 50 period moving average on the SPY. On the DIA, we're slightly more bullish. Okay, so we kind of already bounced a little bit in terms of the CCI on the daily. On the DIA, it's already turning to the upside. Okay. And you can see the MACD is starting to cross over there as well. The one is the most bearish of the three majors is the Nasdaq right now. The Nasdaq led the rally up, and it is obviously leading the decline now because it's very, very interest rate sensitive. Like I had mentioned with Jill, the IWM, okay, the IWM is already in a downtrend. So what you would expect is this kind of action. You see how it broke the first time with the IWM, and then we bounced back up. So the IWM is leading everything. So the Russell will always lead the decline. So here you would expect the same kind of action on this bounce after on the Qs. So look at where the Qs are. The Qs are down here, so we're going to probably bounce up slowly, and then you'll see further decline. But I don't think that we are done with the selling by any extent of the word. Let's take a look at Bitcoin GBTC. Here's Bitcoin. I mean, certainly Bitcoin just got crushed. We put in a top, double top, and then a big time drop. Okay, so Bitcoin certainly took it on the chin. And this is very deeply oversold on the CCI if you look at it there, and certainly hasn't even started to cross over on the on the MACD. Here's the MACD and the CCI triple bottom. Okay, let's just see this. This is CCI, GBTC. Let's take a look at Apple. This is a big one, AAPL. This is a big one, right? Top, lower high, drop. Okay, move down. Apple is certainly moved down off the highs. In terms of the chart, I mean, it looks like it's set up from a weekly perspective to really rally. I think that Apple, from a technical perspective, has not broken its trend line. So there's the trend line on Apple, and you can see it has yet to break the trend line. It's deeply oversold, but it could very easily spike back and come back, kind of piercing that little W-shaped formation. Markets have certainly, they look like they're getting ready for a relief rally in the near term. But certainly we are starting phase 4, which is a market downtrend, possibly going into some correction territory. We are already at correction territory already, but we might go to bear market territory, which is a further 10% down move. Some old economy stocks like X, certainly taking it on the chin. GE, I mean, you go across the market, you're not seeing uptrends anymore. You're seeing downtrends pretty much across the board. Some things like DE, which is John Deere, kind of holding up well, kind of holding sideways. Caterpillar is another one that's coming out with earnings this week. Certainly the old economy Dow stocks are doing better than the Nasdaq stocks. One thing that I want to point out, looking very bullish, although we did have a little bit of a down week this week, is gold. Gold really holding up well. It's been in a kind of a long-term consolidation. And if it can break above this, I mean, let's put the trend lines on here. I mean, gold is in a big consolidation breakout range, meaning that it's staying, if it can break out above that pennant formation, gold could really have some upside, meaning going back to the all-time highs here at 194 on the GLD. A cheap one is IAU, basically the same thing as GLD. It's just a less expensive version. And the other one that usually outperforms gold is SLV. There's SLV, certainly doing well as well. Very similar formation to gold. So certainly keep an eye on gold and silver. In terms of the markets are in correction territory, moving potentially into bear market territory, but I probably would expect some relief rally. I certainly would not be buying any dips. I would certainly be more inclined to day trade and play the mayhem rather than buy the dip. And on that note, I'm going to switch back to the presentation and just give you a couple of updates. All righty. So let's just do our standard updates. Stay up to date with all things DAS by signing up for our monthly newsletter and emails. Simply fill out the form at the bottom of our webpage. Subscribe to the YouTube channel at Dash Trader TV for the Dash Trader Newsroom reminders. Follow us on social media on LinkedIn, Twitter, Facebook, and Instagram. Thank you so much for joining us. We'll see you in 2 weeks. We have our newsletter coming out next week as well. Trade well, everybody, and be cautious. And see you next time.